Hello and welcome to the monthly recap. This for the month ending today, Friday, May 30th, 2025. Month doesn't technically end until tomorrow, but the last business day officially. So, congratulations. You made it through another month. Hope you all had a wonderful month. Hope you had a wonderful Memorial Day holiday. I love May. I've talked about it before, but it's just my favorite month. It's so pretty. Some rain, some snow. I love everything about May. All right. So, lots to get into. It is officially days of our White House. There's just drama after drama after drama. Uh, Happy Mother's Day. Those mothers out there, Cinco de Mayo, of course, and then Memorial Day, which was on Monday. So, what are we going to be talking about today? So, jobs and inflation are going to start there, and then we're going to be talking about the Fed. The Fed has a dual mandate, right? They need to keep prices under control, i.e., managing inflation, and they also want to maximize employment. So, we'll talk about jobs, inflation, and then we'll get to the Fed meeting that happened in May. And the really big one that's ahead, I'll talk about why that's a big one. A little bit of a housing update. Moody's downgraded the US debt. I'm going to talk about why that's really not a big deal. And then mortgage rates ended up finishing the month around 6.875. So they did improve slightly over the course of the month. So let's get right into it and let's start with jobs. So jobs have been on a little bit of a roller coaster. Okay, there's been probably more bad news than good news when it comes to jobs, but it's kind of hard to tell what is going on with the employment market because you have BLS saying very positive things, and then you have everything else saying some rather negative things. So let's start with JOLTS, very fancy name, eye-grabbing name, JOLTS, job openings and labor turnover survey. Okay, so the JOLTS report, the whole goal of JOLTS is to try to measure how many help wanted signs there are across the entire country. So the report for April showed that there was a decrease in the job openings from 7.48 million down to 7.19 million. That's a pretty significant drop in job openings, and it does make quite a bit of sense when you look at Doge and everything else. A lot of places are just kind of freezing hiring until they can figure out what's going to happen with tariffs and the economy as a whole. So, not such great news on the JOLTS report. With regards to the Bureau of Labor Statistics report, okay, that's the one that's hardest to make heads or tails out of. And I've joked before where they should change their name from the BLS report to simply the BS report because they come out with these crazy good numbers and then they revise the numbers much lower for the months prior. And that's precisely what we saw happening. So April jobs report showed 177,000 jobs being created when expectations were for 130,000. That's great news, right? That should be great news for you. You should all be celebrating. But then they revised the prior two reports down 58,000 jobs. 58,000 jobs. That's a huge downgrade. So blockbuster numbers, and then they revise them much lower. It's really hard to tell what's going on with the BS report. I'm just going to change it officially from BLS to BS report. Unemployment did remain static at 4.2%. So the Fed could take that as a little bit of a positive. Hey, unemployment didn't worsen. It stayed static at 4.2%. ADP employment report, that's been much more reliable. Okay. ADP employment report showed there was 62,000 job gains when expectations with ADP were for 120,000 job gains. So almost half. Again, pretty significant miss there. Let's talk about inflation. We did get some really positive information on inflation, and we've been continuing our run of really good inflation numbers, which is great, great, great news. Unfortunately, I'm going to be talking about on the next slide some not so great news on inflation. But let's start with the good news, okay? Producer price index. That's wholesale inflation, okay? So inflation is businesses feel it, okay? What are the prices the businesses are paying? That headline, so all in inflation, went from 2.7 now to 2.4%. Really good, third good number in a row. Core, when you remove the volatile food and energy from that equation, the very volatile components, and again, none of these indexes really want to be at the mercy of, if avian flu broke out or what's the price of gas because of, conflict in the Middle East and like that. Remove those volatile components. What is inflation really like? Core went from 3.3 down to 3.1%. Again, very, very solid improvement. We'll take it. And PPI is seen a little bit as a leading indicator. Idea being if businesses pay less for goods, for raw material, they can pass that savings along to us consumers. Speaking of the consumer price index, that came in at 0.2% in April. Headline went from 2.4 to 2.3% year over year. Okay, that's again the third solid number in a row. The core rate did stay static at 2.8%. Now, Consumer Price Index and Personal Consumption Expenditures, PCE. PCE is the Fed's favorite measure of inflation. If I was only going to be talking about one inflation figure, I would talk about PCE. That is the Fed's favorite measure. Okay, the headline PCE figure went from 2.31 down to 2.15. Okay, so 2.31 down to 2.15. Very solid improvement. The core rate went from 2.67 down to 2.52. You'll see headlines that will say, hey, headline is at 2.1 and the core rate's at 2.5. I included an extra decimal point there. But both headline and core PCE saw the month over month figures increase 0.1%, and the year over year numbers improved by 0.2%, so 0.2%. Again, great news there. Consecutive streak. We're really doing well there. And core PCE. Fed wants core PCE, that 2.5 figure, they want that to get down to 2%. So you could argue we're not that far off. Great news there. Here's the bad news, all right? So the bad news is, and I've talked about it before, but the bad news is this. It is going to be hard to make meaningful progress on inflation the remainder of the year, unfortunately. Now, whenever they look at year-over-year numbers, okay, the numbers today matter a lot, but so too do the numbers that happened a year ago. Because when they add one report, they drop off a report from the year prior. And so we can look at the numbers that are going to start to get replaced from a year ago and start to project, oh, wow, it is going to get worse before it gets better. These numbers from a year ago, 0.08%, less than 0.1%, ouch. 0.22, 0.17, 0.17, very calm numbers here. It doesn't require much for inflation increasing for these cooler numbers to look like inflation is actually increasing, not decreasing. Even if the numbers are very tepid and mild, if they are less tepid and mild than they were a year ago, it's going to make it look like inflation is warming up again. It's going to be hard to make progress this summer, certainly. The fall, September, October, maybe we can make a little bit of progress, but November, another really calm number. It's going to be hard to make progress on inflation. It's not going to be until we get to January or February of next year that these numbers are going to start to fall off. And these were very hot numbers that will start to get replaced. So it's going to get worse and then it'll start to get better. We just got to kind of stay with it. Now, why is this important? Like I said, the Fed has a dual mandate. They want to maximize employment and manage prices, i.e. keep inflation under control. So what happened this month with the Fed? Well, the Fed had their meeting earlier in May, and they did not make any change to the Fed rate. That was actually pretty predictable, and I'll talk about why it's predictable in a second here. But it was pretty predictable that the Fed wasn't going to cut rates, and they surely did not. And here's what Jerome Powell said, okay? We are comfortable with our policy stance. We think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. What he's talking about, uncertainty around tariffs, around trade wars, around trade deals happening. There's just so much uncertainty as a whole, okay? So that's what Jerome Powell. And then predictably, what happened was, actually before I get to that real fast, Jerome Powell emphasized waiting 22 times in his prepared remarks. Those were his prepared remarks. In his prepared remarks, he said waiting 22 times. That was very intentional. Inflation is still above the Fed's target. They would say well above. They want that to get down to 2%. It came in at 2.5%. So still above the Fed's target. Unemployment is still low and stable. It did not increase any worse. And again, with all the trade talks and the tariff talks, there's so much uncertainty out there right now. It's not surprising that the Fed didn't cut rates. It's also very predictably, like I said, though, that this got the ire of the administration. Trump called Powell a fool who doesn't have a clue. Like, wow, those are fighting words if I've ever heard of. The president actually invited Jerome Powell to a meeting at the White House. That actually occurred yesterday, Thursday, on May 29th. And the Fed statement after the meeting, I love this statement because it's just so perfectly Fed. Okay, here's what they said. Chair Powell did not discuss his expectations for monetary policy, except to stress that the path of policy will depend entirely on incoming economic information and what that means for the forecast, for the outlook. What they're saying is, look, the Fed is independent from the administration. That's very intentional. Because if the administration was in charge of the Fed, you know what would happen with every single administration? They would cut rates. Let's leave rates at zero. Let's absolutely slash and burn rates to increase spending because that makes me look that much better. And there are a couple countries out there where the Fed and the administration are directly connected to one another. And they have rampant inflation for that exact reason. So this is Jerome Powell basically doubled down and saying, hey, you guys can, tell me what you want me to do. You can tell me to cut rates. You can tell me I'm acting a fool and I'm waiting too long to cut rates, but I ultimately do not answer to you. Okay, I am independent, and we're going to be entirely dependent on incoming economic information. Such a perfect Fed statement right there. Now, it's not unheard of for the chair of the Fed to meet with an administration. In fact, during Trump's first term, they met twice. During Biden's administration, they met once. So it's not unheard of. It is rare, but it's not unheard of. And the Fed basically just doubled down their stance and said, sure, we'll hear you out, but ultimately at the end of the day, we do not respond to you. Now, there is a pretty significant Fed meeting coming up. I mentioned at the outset that it was somewhat predictable that the Fed wasn't going to cut rates in May, and here's why. Each of these bold meetings, okay, so March, June, September, December, is a meeting associated with a summary of economic projections. That's where the Fed doesn't just decide what they want to do on rates, but they actually will show their work. Where do they think rates are going to go from here? Where do they think GDP is going to go from here? Where do they think unemployment is going to go from here? They have to put pen to paper and show their work. So all things being equal, they would prefer to change rates at these meetings associated with a summary of economic projections so that they can show their work and give a little bit more context for their decision. June 18th is one such meeting. Now, inflation's been coming down. Again, 3 consecutive months of positive improvement, only 0.5% above the Fed's target for core PCE. Unemployment, stable, is not getting any worse. Was getting worse a little while ago, but it's been stable as of late. All of that you would figure would give the Fed ammunition to cut rates. I think today, May 30th, that I think they probably will cut rates at that June meeting. I think the stage is set. I think they didn't do it last time, even though they were getting pressure to do so. And I think they kind of proved their point of, hey, look, we are still independent. I think that they probably have enough runway to make a rate cut if they want. 0.25%, 0.5%, that's a good question. I would hope for 0.5%. I think it's possible. I think the Fed does have enough ammunition to do that. Do they hedge and just do 0.25% instead? We shall see. They could also come out and shock everybody and do no rate change. I think that's probably a little bit less likely. I think they probably will cut rates. We shall see. Quick update on housing. So the Case-Shiller Home Price Index, okay, that measures appreciation, home price appreciation across the entire country. They also do a really good job because they include all transactions, so cash transactions, jumbo transactions, conforming loan amounts, everything. They also break it down to the metro area, which I really, really like. So they said that year over year, so from March of 24 through March of 25, admittedly, it's a little bit dated, it's a couple months old now, homes appreciated 3.7% across the U.S., in Denver Metro, it increased 1.35%. So lagging behind the rest of the country. However, worth pointing out that post-COVID, Colorado is one of the leading areas for appreciation from housing. So honestly, a little bit of a moderation is probably not the worst thing in the world. 1.35% is still positive. Not only that, but it's also, if you put 5% down and you're getting 1% appreciation, you're actually seeing like 20% return on your investment. Not bad. New construction data. This is really interesting to me. So, tale of two signs with regards to tale of two halves when it comes to the real estate market. So, existing home sales, they've been kind of taking it on the chin a little bit. Okay, rates have been elevated. There's been now 3 years of pent-up demand, but year-over-year sales are only down 2%, so that's not bad. Inventory, however, across the country is up 21%. That's been grabbing a lot of headlines, and a lot of people have been pointing to that. Like 21%, that's bad. You've seen some headlines that say, "Hey, inventory is at the highest level in 5 years." It's worth pointing out that that's extremely anemic levels that they are coming off of. Okay. Also worth pointing out that there's only 4.4 months worth of supply. A balanced market is considered 4.6 months. So it is technically still a slightly seller's market. I would argue just purely, balanced market. Even with the uptick in inventory, still considered a balanced market. And the second rates come down, we're going to see 3 years of pent-up demand try to enter the market. So I'm still very bullish on the housing market as a whole. I think as soon as rates start to drop, we're going to see a huge influx of buyers into the market. Fannie Mae and Freddie Mac did come out recently, and they said, hey, look, we think rates are going to settle somewhere around like 6.1% by the end of the year. A lot of speculation in there, but that's their updated estimate on where rates are going. New construction data, really interesting stuff here. So while existing home sales have been kind of lagging behind, new construction has been having a heyday. A lot of the reason why is because builders and lenders can incentivize buyers to buy their home, so they're throwing a lot of money at those situations. Builders are currently on pace to build 1.36 million homes this year. That's important because household creations, how many households are created each year, that's around 1.8 million. Well, what that tells you is supply and demand. The supply is simply not going to keep up with demand, especially when rates drop, especially when we have all these buyers entering the market. So a little bit of an update there. All right, let's talk about the Moody downgrade of the U.S. debt. Okay, so there's 3 credit agencies out there. There's Moody's, Fitch, and S&P. Those are the big 3, and they grade kind of like FICO does, TransUnion, Experian, and Equifax for a home buyer. They grade government debt. What is the likelihood of default? What are the rates they should be offering? That kind of thing. Well, Moody's downgraded the U.S. debt from AAA, which would be perfect, down to AA1. Okay. Now, it's got a little bit of a headline, and I've talked about it before, but honestly, in the grand scheme of things, it's probably not a big deal. First of all, Fitch downgraded our debt 2 years ago. Second of all, S&P downgraded the debt 14 years ago. So Moody's is just way behind the curve. I don't know what they're doing over there, but they're taking their sweet time. Secondly, only 9 countries have a perfect credit rating, and the U.S. is still in the second highest tier. It's like if a buyer's credit score went from a 780 down to like a 770 or 760. It's still stellar. It's just not quite perfect. Okay. Now, the bond market did initially react somewhat poorly. If you downgrade the debt rating, if you downgrade the credit rating of a country, investors are now going to expect a slightly higher yield to compensate for that higher risk of default, that perceived higher risk of default. So the market reacted kind of negatively one day, and then they kind of clawed back their losses the next day in the coming weeks. So really not a big deal in the grand scheme of things. Like I said, this is honestly probably long due. They were way behind the curve. All right, so what's next? So June 18th Fed meeting, huge meeting. And since inflation is going to get worse before it starts to get better, this is kind of like the Fed's last chance, right? For the next few months at least, to cut rates if they want to cut rates. They've got all the wind to their back, all the wind to the back of their sails. Like if they want to make changes here, like now's probably the time. 3 consecutive months of improving inflation. Like if I was in their shoes, I'd be like, that's enough runway for us to go ahead and finally make a Fed rate cut. It is going to be hard to make up the ground on inflation going forward. Unfortunately, it's going to get worse before it gets better. It will get better though. What's going to go on the jobs market? Jobs. We do not have to wait very long for this. We are going to be getting updated jobs information next week. So next week is jobs week. Going to be really interesting to see what those numbers come in. And then all the days of our White House, right? More tariffs, less tariffs. The one big beautiful bill. It passed the House, but it still has to pass the Senate. I think they've been given a deadline of early July to officially sign off on that. What will likely happen is they'll have their revisions. They'll send it back to the House. The House will have their revisions. They'll send it back to the Senate. A little bit back and forth before they finally come up with some kind of agreement. But what's going to happen with that? Trade deals. There was a lot of talk about trade deals earlier in the month. Unfortunately, most of them were found to be like less trade deals and more like framework for trade deals, which is very, very different. Like, here's kind of like, basic foundation. That's very different from saying we have a trade deal, right? And it was initially kind of sold as a trade deal. It was really more of a framework for a trade deal. So what else evolves from there? Going to be interesting stuff. All righty. Thank you all so much. Hope you had a wonderful May. I know I did. I really appreciate you all. Thank you all so much for all the referrals. It is the lifeblood of our business. We never take it for granted. Always really, 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 really appreciate you. So thank you all so much. I'll see you next month. Thanks. Bye.